Good morning. Welcome to KBRA's Bank Talk, the webinar. Today we want to bring you perspectives on the U.S. banks in this age of COVID-19. My name is Van Hesser, Chief Credit Strategist for KBRA. Joining me today are Ethan Heisler, our prolific researcher in the bank space and author of the KBRA Bank Treasury newsletter, Joe Scott, who presides over our industry-leading U.S. financial institutions ratings business, and Nathan Powell, who runs our bank data business, KBRA Analytics. Nathan's product is the foundation that all of our bank work is built on, and we'll give him a moment or two toward the end of our presentation to let you know how you can tap into this resource. So without further ado, let's set the stage. Next slide. So heading into 2020, we're in the longest period of economic expansion in recorded history, fueled by global QE that drove rates to structural lows, triggering a search for yield on the part of investors that held their nose and accumulated risk. Credit risk, financial risk, really leverage, and liquidity risk. Then the black swan appeared. Policy responses moved gradually towards shutdown and isolation, which has triggered economic collapse. Unthinkable contraction in the second quarter is on the way, estimates as high as 30%, and spiking unemployment on the back of jobless claims. These numbers now look like 15% in April. None of this, of course, is good for banks. The good news, the surprisingly good news, is that in the space of 1 week, the Fed, who most assumed was working with a diminished toolkit, and Congress came together to put in place a larger than anyone expected relief and support program aimed at building a bridge to the other side of this health crisis. Stocks rebounded, investment-grade debt capital markets opened with abandon. Now, we hate to rain on a good parade, but we believe we are entering a more difficult phase, one defined by an acceleration of the health crisis, shocking economic reports, dire earnings guidance from Q1 earnings releases, and concerns about getting funds out to people and businesses that need it the most. Over the balance of the year, we are skeptical that we will see a powerful snapback. We believe we will be different coming out of this than where we were going in. We believe individuals will be slow to evolve out of social distancing. They will be less willing to travel, less willing to attend large gatherings. We believe businesses, those that survive, will be more cautious in managing their enterprises. They will diversify supply chains, maintain more inventory, hold on to more cash. All of this, of course, comes with added cost. There will surely be those businesses that benefit: tech, healthcare, consumer staples, home delivery, but probably not enough to offset the broader headwinds in the economy. So our view is that we are looking at more of a, if I were to pick a letter, or not even a letter, a backwards J type recovery. We expect the recovery, once a cure is made available, but we believe it will take time to return to even 2% growth. All right, so let's try and put this unprecedented event into some kind of context. Let's go back to 9/11. Black swan event for sure that shocked and undermined confidence, especially in travel-related industries. The economy, however, contracted for 1 quarter and then quickly recovered. Don't think that's the right episode here. The global financial crisis is probably a more useful comparison. A rolling shock, localized in the financial system that would ultimately result in credit crunch and economic freeze by the fourth quarter of 2008. GDP contracted 8% in that quarter. Compare that to what we're looking at today. Unemployment peaked at 10% a year later in the fourth quarter of 2009. Highly politicized, made fixing this problem difficult. But in the darkest hour, the government set up emergency funding programs for the banks, injected stimulus equal to 5% of GDP, again, compared to 10% last week. Economy came back in about a year, but the unemployment took a while to reduce and didn't get below 8% for 3 years. In comparison, this has the potential to be worse. More of the economy is frozen. Unemployment could be worse. Certainly looks like it will be worse. We just don't know at this point. It's hard to manage something you struggle to measure. What will turn the tide is a cure. Getting through the period of the search for the cure depends on the effectiveness of government programs in preserving as much of the economy as it can. And both are decidedly uncertain at this point. But we know the pandemic will leave a mark on the banks. In the great financial crisis, the industry basically reported two break-even years, 2008 and 2009, with credit costs, again, wiping out profits in those years. Interestingly, we generally associate large bank issues with the GFC. Fact of the matter is all banks, all sized banks, reported similarly impacted numbers in those years. And that helps explain something that I found surprising. Think about all the industry sectors and their equity performance year to date. You'd think the worst performers would be airlines, oil and gas, hotels, and you'd be right. Next up, the banks. KBW's large bank and regional bank indices are off 46% and 44% respectively. Compared to the S&P, down 24%, and the Russell 2000 down 36%. The banks, again, are underperforming in the face of this pandemic. Now, one point to make as we think about risks in the financial system, we do believe policymakers have no incentive to create a financial crisis out of a health crisis. That means we would assume that if the banks need help in getting through this downturn, we believe it would be forthcoming, especially pertains to supporting the Main Street economy. So what are banks doing? Post the GFC, regulators moved to shore up the banks, significantly increase capital, liquidity, reduce risk, so they can be a source of strength when an economy needs them. Certainly needs them now. Great in theory, doesn't really work that way. Banks are not going to step up and catch falling knives any more than investors will. The best you can hope for is that they are there to meet their funding obligations and don't become part of the problem. To get a better look at the bank's ability to do this and be part of the solution here, I'd like to turn it over to Ethan. Ethan?
Thanks, Van. Thanks very much. And hello, everybody. Thanks for joining us today. Van, you know, historical data can be very helpful in helping analysts understand what to expect in this crisis. Though I think there is good reason to expect that the evolution of problem loans and losses may be a lot faster in this cycle than in the previous crisis. For one thing, we essentially fell off of a cliff at the beginning of the month. And it matters that people wake up every morning. I know I do this, and the first thing they do, at least, is check the new coronavirus numbers. It seems like almost a natural thing. That certainly does not put people in the mood to feel good about the economy, good about the future, or anything. I think it's also, you know, we just saw this morning we had jobless claims, 6 million in 1 week on top of the 3 million from last week. I mean, put that into context. We had 2 months ago or a month ago, we had new jobs, which will be coming out, of course, tomorrow. We had new job numbers of about 200,000, which was a really good number. And we've been booking somewhere between 150,000 new jobs and 200,000 new jobs every single month. And now, in the space of 2 weeks, we have reversed something in the neighborhood of maybe 2 years or 3 years worth of growth of numbers. That's quite a number to wrap your head around. I think it's also worth remembering, before we look at some of the slides I want to show, that, you know, this economy was not going gangbusters. Before this crisis, we needed the Fed to cut rates to stave off recession. They cut it 3 times, not because of the coronavirus, but because the economy was weak and they were worried about GDP falling back and certainly falling below 2%. So then you throw in this crisis, and it feels to me like there's no great snapback that people should be expecting here, and that problem loans will probably remain elevated for a long time, well beyond the point when we turn the tide on this plague. And I think that is the reality that we will start to absorb. Now, one big question is the borrower response. You know, corporate issuers, drew over $250 billion in new bonds in the last couple of weeks. And if you look back at the last crisis, the two big areas for drawdowns was in credit cards and in commercial and industrial loans. And both of these are almost entirely specific to the largest banks. So if we look here on slide 3, you can see how credit cards back in the financial crisis, that the evolution of those cards changed so that cards went up initially in 2008, as you see, and then they fell back to pre-crisis levels in 2009. So that's first point. Second point is, I would say, is as you look at this graph, overall, this doesn't really suggest that there was a significant amount of increase in the amount of credit card outstanding during that financial crisis that was drawn down by consumers. Now, you'd expect you lose your job, you're going bankrupt, your credit card is your last lifeline to pay the bills or to pay your groceries, if nothing else. So you'd expect people to draw max out the limit because they've lost the job. I think these numbers sort of say, yeah, it's more of an urban myth to think that there would be a huge amount of drawdown. It seems much more modest, and that makes sense. If you think about it, banks have already limited this increase since the last financial in terms of their credit card originations. They've tightened up those procedures. They certainly have backed away from the subprime markets as much as they were in before. And then I'd also point out that the new CECL accounting rule is has, if not will, mute bank appetite for credit cards because this stuff probably has the highest amount of reserves that you would attach. On January 1, the banks that adopted CECL and had credit card exposure actually saw a doubling of their initial reserves for CECL on Jan 1 to take the transition, whereas banks with commercial and industrial loans saw a reduction. Now, of course, that was all pre-crisis, so the numbers will look a lot different. But those are 2 points to keep in mind. Now, if you go to slide 4, we can see the evolution of commercial and industrial loans. So, like with cards, borrowers drew down on lines in 2008, and then again in 2009, the balance of loans reversed the growth. So, also as you saw with cards, C&I loan drawdowns were mostly concentrated with the 25 largest banks. I think it's really worth remembering that, the United States is a very different capital market than the capital markets that exist in Europe and Japan. Because in Europe and Japan, the banking industry represents 80% of the entire capital markets. Whereas in the United States, the banking industry only represents 20% of the capital markets. So again, as I mentioned earlier, there was corporate bond issuance here, significant corporate bond issuance. We're likely not to see the same kind of growth in bank numbers in this quarter, despite the fact that the industry is braced for this, than we may have even seen in the last quarter, because the shadow banks, the pension funds, the other asset managers that have dry powder to invest are going to snap up these corporate bonds, are going to be there for that market if they believe in the future, which we hope they do. But I think that's worth keeping in mind as we go into Q1, what kinds of numbers we're seeing. If you look at weekly H8 data from the Federal Reserve, you don't really see yet a significant increase in commercial and industrial loans growing, which would be consistent if they were with corporations pulling down on their lines. So we'll see how this numbers evolve. I am curious to know whether or not there will be a lot of appetite. One thing that I've checked, and I advise everybody to do this on a regular basis, is the Federal Reserve has now announced a commercial paper program and a bunch of other programs. Obviously, they've announced the Main Street and so forth. But think of commercial paper, which the commercial paper program is only limited to the A1P1 names. But just think about how much of that has been drawn down. Or the Fed is now offering its discount window up to term up to 90 days at 25 basis points. As of last week, there was only $50 billion of discount window loans out of the Fed. So I'm not sure the Fed is providing a lot of backstop, but at some point this liquidity has to get into the market. We have to actually see something going on. I haven't seen any evidence of that. So let's go to slide 3. The next slide. If you look at the next slide on the net interest margins, net interest income as a percentage of total net revenues, which is what I have here. What you see is that clearly, as you would expect, regional and community banks are going to be more exposed to net interest income and reliant on that than the larger institutions. In an environment where the Fed is lowering interest rates, I've lowered it to 0. Presumably, last cycle we were 7 years in a 0 interest rate policy. It's an open question how long the Fed will keep it at 0 interest rates. It could be a very long time, could be longer than this. That certainly will put a lot of pressure on our margins because your deposit funding costs already going into this cycle were pretty much floored, and banks were already preparing the analyst community to expect NIM compression because there was just nowhere to go for their funding costs. On the other hand, yield on loans were as C&I loans roll over, those loans are going to roll over at a lower yield. Your securities portfolio is going to roll over at a lower yield, and that is going to drag down margins. So I think that you have the potential for a higher spike in credit costs. You have at the same time a lower revenue base to absorb those costs. That is certainly putting a lot of pressure on the entire industry. I do think that when you look at credit costs, so let's look at the next slide. When I look at credit costs here, I think about the last financial crisis, and this is FDIC data for banks between 10 billion and 250 billion in total assets. But for those institutions, you can see how the provision for loan loss to average loans shot up essentially by over a period of 18 months by 400 basis points. And that's old GAAP, remind you, it's not CECL. So my expectation is that in this cycle, we might actually see that pop a lot sooner. Keep in mind, one thing that I think is often misunderstood about current expected credit loss is that it doesn't increase the amount of impairment that banks recognize. It just moves up the date of that recognition. So you'll still recognize the potential losses, you'll just recognize it earlier. In this cycle, as I said earlier, where we just basically fell off of a cliff, it's quite possible that we'll see this run up a lot faster. And I think that should give people a lot of pause, but it probably is a good opportunity for me to turn it over to Joe Scott, who can give his perspective on where he sees all of this laid out. Joe?
Thanks, Ethan, and thanks everyone for calling in. First of all, I just wanted to say that we have a stable rating outlook for our U.S. banks. We rate over 120 banks, primarily community, regional banks focused on the U.S. economy. It's important to note this is a rating outlook, not a financial outlook. As banks face a tougher economic environment, problem loans will certainly increase considerably from what is now a very low base, and margins, as Ethan mentioned, and profits will be pressured. However, we expect problems to remain manageable relative to the core earnings, reserves, and capital. Really, some of the key takeaways on our rating outlook: solid financial fundamentals provide a very strong starting point going into this very difficult period. Profitability, capitalization have been very sound. Problem loan levels were at multi-year lows at year-end 19. And then I think very importantly, there's been a sea change in capital management. The TCE, or tangible common equity ratio, for community banks, regional banks, is over 200 basis points stronger than before the financial crisis. That is a really comfortable added reserve, so to speak. And then for major banks, the difference is even more stark. It's over 300 basis points stronger now versus before the financial crisis. As we look at our rated universe, there's just a handful of rated banks that have sizable direct exposure to very vulnerable industries, notably energy and some with hospitality exposure. These institutions are being monitored very carefully with dialogue, possible rating actions, outlook changes as needed. Some of the other exposures, the so-called first tier or phase one exposures like aviation and shipping, the exposures of our banks are generally very minimal to those segments. And then we also look at exposures to other riskier asset classes, particularly construction loans. And the good news there is construction loans are far lower as a percentage of total loans in the industry now versus before the crisis. These exposures were generally a source of very large charge-offs in the aftermath of the financial crisis. So the good news there is the vast majority of banks have exposure to construction lending considerably below the regulatory guidance and much lower than at 05, 06 going into the financial crisis level. So as Ethan mentioned, net interest income is going to remain under pressure naturally with the Fed actions for most banks. But we want to keep in mind that net interest margins for the U.S. banks will remain very favorable in many international comparisons. And we believe U.S. banks can really price effectively for through the cycle risks. Also, in many cases, loan floors on prime and LIBOR-based loans will help. And then for our rated banks, deposit costs on average are still at 1%. So there still is some leeway to reduce depository costs for our rated universe. And we're talking to a lot of banks naturally, and we're hearing that many banks are having the flexibility in this environment to significantly lower their deposit costs. So that's naturally going to be a lag effect. There's going to be pressure on the margins. But at the same time, with the combination of loan floors, some leeway on deposit costs, we think the margins will generally remain quite favorable in, I would say, most international comparisons. And then I think another key factor for the stability of the community bank space, regional bank space, is that liquidity is much more conservatively managed than before the financial crisis. And banks generally, and this is a key advantage versus non-bank financials, they benefit from high levels of FDIC-insured, stable core depository funding, and then also have large capacity generally to borrow from the Federal Home Loan Banks in the event of need. And this is a key reason for a very low failure rate of community and regional banks over time, and a key advantage, as I said, of banks versus corporates, finance companies, other types of non-bank financial institutions. And then, oh, by the way, you have the capacity to borrow from the Fed's discount window in the event of need, and more are doing that. It's a very low-cost funding source. And then just recently in the fiscal package, the FDIC was authorized by the government to reinstate the TLGP program. They haven't done so yet, but during the financial crisis, the TLGP program was very important in stabilizing liquidity and funding, particularly for major banks. So in summary, the bank ratings are meant to provide a durable through the cycle credit view and accommodate far higher problem loan and loss rates. Now I'd like to turn it over to Nathan.
Thanks, Joe. I think this has been a great discussion today, and I'm really excited that the data from KBRA Analytics could help support everyone's analysis and the visuals in these slide decks. So the KBRA Analytics bank data platform went live a few months ago, and this platform provides complete coverage of the U.S. financial sector. So that means banks, insurance companies, real estate, and other finance companies. So through our web app and Excel add-in tools, you get access to bank regulatory filings, GAAP fundamentals, all the associated ratios and metrics, and all the other core data sets that you need to analyze the industry. So that means our tools let you conduct company performance evaluations and benchmarking, valuation modeling and merger modeling, and also thorough risk analysis, similar to what we've just been doing today. I know it's times like this when data and analysis matter the most, and at KBRA Analytics, we're here to help you in any way we can. We want to help you do all the analysis of the industry when it matters the most. So as you can see on the screen here, if you download the PowerPoint deck, we've got links to our demo. It's on YouTube, and you can also go to our website where you can request a live demo. So with that, I'll turn it back over to Van for some concluding remarks and also a Q&A session.
Thank you, Nathan. Next slide. And one more. So again, interesting times we live in. As analysts, we think it's still early, right, to judge whether the responses by the Fed and the U.S. government will be effective. Size, no question. Larger, 10% of GDP, larger than anybody expected. Designed to get at all of the vulnerable points in the economy. Execution is going to be critical here, and that's where it's a huge task. Getting money out to people who need it when they need it is going to be difficult, especially for small to mid-sized businesses, and that's what we're really going to watch in terms of how effective this ultimately is going to be. Therefore, the temporary and lasting damage to the economy is still unknown. Right? This is all a function of the health crisis and its progression. That said, when you increasingly freeze the economy, which is happening state by state level or state by state, it is going to be a significant headwind towards economic growth. Social distancing will speed up technological changes underway in the banking services delivery model from branches to apps on mobile devices, right? So the industry will evolve to all of this. As I said earlier, we will come out of this changed from how we went into this, and a lot of things in terms of technology, for good or bad, are going to take root as a result of this episode. That may drive further consolidation in the industry as stronger banks acquire the weak and as technologically enable the banks or favored banks start to acquire those that aren't. So taking out capacity, reducing competition, building scale, diversifying risks, long parts of our analysis that generally make bank-to-bank M&A a credit positive story. And lastly, we think bank investors should brace for higher credit losses and weaker revenues. We talked about margin compression. It's really going to be the loan loss provision number that is going to be one that we will watch. We'll start to get a look with first quarter earnings, not in terms of what's been done already, but really what that future look is going to be. That future guidance, I think, is really going to shape investor confidence around how banks are identifying the risks in their portfolios. And that's going to come, obviously, in a couple of weeks. That said, you heard Joe Scott talk about the durability of the industry and the ability to weather the storm. Worth mentioning that we talk a lot about industry data. You're picking up everything, the good and the bad. Generally, what we rate tend to be the stronger community and regional banks. And so their numbers, we think, are more durable. Their risk management better than the average community or regional bank. And therefore, that should be taken into consideration when we talk about the ability of our rated universe to ride out the storm. So with that, I think we can, I'm going to throw it back to Ethan, who is going to conduct we've gathered questions in advance, and we'll have Ethan start to go through some of those.
Thanks, Van. Before I do that, though, I had one extra point to just make, which is, as I've talked to a lot of banks now over the last week or two, one comment that keeps coming out is operational capacity. And it's a good question. If you're analysts on this call and you're thinking you want to participate in the next earnings call next month, a good question, I think, to ask banks is, how do they go about processing? Where are they going to find the resources to process all the loan applications for mods, for new, for lower rates and other relief? If you have swaps, a lot of banks I know have done swaps with their business customers. All of those guys are looking for relief or change in the rates, and that there is, a lot of institutions don't actually have those resources. It's going to be a very slow process. I wonder, what if we have a lot of good stuff out here, a lot of good programs, but if they can't really avail of them fast enough, that too will have some damage. But anyway, let's, with that said, Joe, I have some questions from the studio audience, our coronavirus safe studio audience in their own homes. But first question for you, Joe, is what are your expectations for the evolution of credit costs? How quick is the ramp in the provisions and non-performing assets, net charge-offs? What are you looking for in delinquencies and forbearance in the C&I space? And then I guess, in terms of the overall franchise, in terms of these lending, these big portfolios, what do you see there?
Yeah, thanks, Ethan. Great question from the audience. As we look at things, I think as we look at the quarter-by-quarter basis, we're looking at the first quarter. Loan loss provisions, I think for many, if not most, will begin to rise significantly. But these provisions will be forward-looking as there's more watch list loans as well as criticized classified loans that begin emerging in bank loan portfolios. But if you look at the first quarter, we believe actual non-performing loans will remain low initially, but with these criticized, classified, watch lists gravitating up, we won't be surprised if many banks really front load the loan loss provisions, CECL or no CECL. So, but as we gravitate into second quarter, third quarter, if the government financial programs for small business, individuals, corporations are really not that effective or they're slow to be implemented because of some of the issues Ethan mentioned and Van mentioned about capacity of doing the paperwork and so on, then you could see an actual increase quite a bit in non-performing loans, and also as the economy slows. In addition, banks are negotiating, as Ethan mentioned, forbearance with borrowers for various loans, swaps, etc. But because of that, disclosed non-performing loans could be potentially understated as we go into this tough period. So it's really tough to gauge everything, but initially provisions will go up quite a bit. And then if things don't stabilize and the economy doesn't improve in the second half, then you could see a significant rise in non-performing loans in the second into the third quarter. And then as banks assess collateral levels at that time, then you could see charge-offs beginning to emerge at pretty high levels. But I think at the end of the day, charge-offs in our view would remain pretty well contained because of much more conservative LTVs, both in consumer, like residential real estate, and commercial lending. Keep in mind that the vast majority of our rated banks are traditional secured lenders with pretty conservative LTVs. We're talking about, like, if you look at portfolio averages for CRE, it's in the 60% range, maybe in the 50s in some cases. So there is a lot of leeway, keeping in mind that values could go down quite a bit, but they're in a much better starting point now versus before the crisis. And like I mentioned earlier, also the construction component is much lower now than what it was. And that was a really big source of charge-offs during the financial crisis. So we still believe that charge-offs, even in this more elongated scenario, could be pretty well contained. I think it's tough to come up with actual levels, but what we do is we'll stress test the banks during the rating process. We use pretty onerous stress rates for various categories of loans. And because capital ratios are so much stronger now than what they were before the crisis, the banks generally have very adequate capital even post this stress, where we haircut the net interest margin, we haircut the non-interest income, we ramp up the charge-offs considerably to crisis level charge-off rates. And even with all that, the capital ratios generally remain above the regulatory minimums to be considered well capitalized. So I think the system's in a good place, but time will tell on a lot of this. And then
Joe,
talking
just
about,
follow up on that for a second. Can I ask you a question and then there was a second question from the person who asked
I
this
was
question.
going to get to the franchise lending first, but
Oh, okay, go ahead.
yeah, and then as we talk to banks, we have a few that have significant exposure to so-called franchise lending, including hotel, restaurant franchises. It's naturally a concern. The good news is we have well less than 10 banks out of over 120 with hospitality loans greater than 10% of total loans. So for the vast majority of the industry, the hospitality exposure is quite low. And those active in the space are very experienced, but of course this is unprecedented. But we're hearing that many franchisees are receiving support from the large franchisors, the large companies that franchise these rights. But how long this lasts is tough to predict. Also, keep in mind, franchisees and franchisors can both potentially take advantage of some of the government programs to buy time. It's basically liquidity support. Franchisees can go through the SBA lending program, the $350 billion program. It's designed for companies that are below 500 in employees. It's essentially a grant program as long as you use the money for payroll, rent, utilities, etc. So that could buy these companies some time. And then franchisors, potentially, if they're a large company, to go through the corporate program with government in conjunction with the Fed's credit facility. So all this can help, but at the end of the day, it is a higher risk lending category. Very few banks have significant or sizable exposure, but those that do, we watch very carefully. And as you also drill down in the different types of franchises, some franchises are naturally more resilient than others. So really, we want to drill down deep with each of these banks and really get a good handle on their ultimate risk. Thanks.
Joe, just to follow up to that, if I have a loan to value of 60% and the collateral's value, say, falls by 30%, just for argument's sake, big numbers, how long would you want to, before you got worried, or how long would you expect for banks to cure that LTV before it would become a problem from your standpoint? Like, would you expect them to cure this within the next 6 months and do a big margin call with their customers, or what?
Well, what happens is generally the loan would have to go non-performing first, and a lot of times these people that are bankable credits have a lot of financial resources beyond the property. So many times, because these borrowers have a lot of equity in the property, say in your hypothetical scenario, they have 40% equity in the property, they may view this as shorter term, maybe not a medium to long term issue. And because they have so much skin in the game, so to speak, they may keep paying the loan, or they may renegotiate the loan on a proactive basis. So time will tell, but first you have to have the default, and then the bank goes through a whole process of evaluating and potentially seizing the collateral. So this could be very long, drawn-out process. And I think at the end of the day, we would look at it very much on a case-by-case basis and a bank-by-bank basis. And we have a very large team. We have a team of 15 analysts covering the sector, both banks and non-bank financial institutions. So I think that's how it would play out.
Okay. Let me ask you one more because I want to keep to the time. How do you anticipate ratings to evolve in the event the duration of the crisis is longer than expected, particularly in the community bank space? What particular exposures are you most concerned about? For example, energy, retail hospitality, etc., other concerns?
Yeah, that's really the million-dollar question. I think as we look and we go into the back half of the year and we don't see any signs of a meaningful recovery in the back half, and we see non-performers escalating, charge-offs starting to emerge, then we're going to, of course, take a careful look. And we look at these banks all the time. But at the same time, as I said before, these banks have very durable, very low-cost funding, very stable versus non-banks and corporate, combined with heavy regulation. So we believe at the end of the day, the failure rates for banks are going to remain extremely low. And at the same time, the vast majority of our debt ratings for banks are either triple B minus, triple B. So we generally feel very comfortable with ratings at those levels. Now, it would be a different story if the bulk of our portfolio had ratings in the A minus, A range, but we're talking low-end investment grade to begin with a heavy regulated industry with very durable funding and a very low failure rate. So even though we would be very concerned if the economic slowdown extends well into the second half, I still think at the end of that day, we feel pretty comfortable. And keep in mind, many of our rated banks remained profitable during the financial crisis. So there were all the stories in the headlines with the bank failures and the disaster at the major banks. But many of our rated banks, it was an earnings issue. Earnings went down, but they remained profitable because of knowledge of their local markets, top-tier customer bases within their local markets, and conservative underwriting with pretty conservative LTV. So I think we feel pretty comfortable. But that would be something that I would say would trigger a really intensive look if we didn't see any progress on the economy, because as I mentioned before, the bulk of these banks don't have much exposure to these specific vulnerable sectors. It's more the broad-based economic exposure. So if we don't see that turnaround that many are expecting in the second half, then we take a fresh look.
Okay, that's great. Now, Van, we had a question. We've been talking about CRE already, so I know you're prepared to talk about that. But I'd like to I got another question in that I think is also equally interesting and probably even more to your wheelhouse. So here's the question. We've seen these large bond issuance taking place in the market, and these issues have been oversubscribed and credit spreads have tightened. But on the other hand, equities continue to trade at lower levels. So the question really is, and if you have a thought on this, why do you think there's a disconnect between the debt and equity markets?
Well, good question, Ethan. A lot of markets clearly are in disarray in one way or another. If we go back to sort of the classic divide between credit and equities, equities are growth and margin, right? So the prospects for growth and margin have diminished clearly as a result of this. The uncertainty around the future degree of this crisis still to be defined. And so we have a classic sort of run for cover reaction, and quite frankly, the speed at which we've never seen before. On the credit side, when you've got the kind of support provided by the Fed, right, going in and supporting the investment grade side of the market, all of a sudden you've got a real backstop in terms of value. Does that distort ultimately risk and reward in the space? Debatable, but it's undeniable that you've got the buying power of the Fed and an endorsement from policymakers to support the strongest corporate issuers out there. And so that's why you've seen the market come back. Ultimately, this is the Fed, favoring investment grade issuers at the expense or not supporting the leverage finance or speculative grade part of the world. There's clearly going to be pain felt in that part of the world. The Fed has been warning against the excesses in leverage finance now for years. And so it's probably not surprising that they decided to favor just the investment grade side. But as a result, you're going to see a real divergence in how those two particular parts of the corporate bond market react.
Okay, and then here's another question that somebody sent me as we were talking. This was a follow-up to the question I asked Joe, but I think it's worth that this is a good one for you to touch on. Tangible equity. So I would expect that if provisions for loan losses increase as much as we think they might, that tangible equity will be worked down. So what is your thoughts about how soon investors should expect tangible equity in the bank space to recover? And what are you looking for? Is it this year, next year? Do you think that from a credit analyst perspective, you get comfortable if banks were, like we just saw the CBLR, the Community Bank Leverage Ratio, 9% minimum, and the CARES Act says that we can lower that temporarily to 8% till the end of this year. Is that something you think that from an analyst credit perspective, you get comfortable with a lower ratio for a bit and then with the expectation it comes back? And then if you don't, like Joe is saying, if we don't start to see recovery in the second half, you take a different look at that?
Well, let's unpack that a little bit. So if you're talking about what would pressure TCE, tangible common ratios, you're talking about losses, right? So if we go back again to context of being 2008, 2009, industry profits were significantly impaired and almost wiped out. But you didn't drive TCE ratios for many institutions lower, again, because you were at least operating at break-even sort of levels. Post all of that, of course, the regulators have significantly increased the capital requirements across the industry. As Joe mentioned, we look at sort of reserves and equity together as the cushion following earnings, right, as the lines of defense against rising losses. So the industry is in much better shape today. Look, at the end of the day, it's highly levered, regardless of whether those ratios are, TCEs are at 8 or 9 or 10%. We'd always love to have more capital than not. But at the end of the day, this is really about the industry's ability to regain profitability. And I think all of that, of course, is going to hinge on the depth of and duration of this recession, all to be determined. But let's not lose sight of the point that Joe made earlier that the industry is in much better position today. And especially if we talk about, let's say, the top half of the industry, those that are going to be, candidates to get rated and access capital markets. The better institutions here are going to have better franchises. They're going to be more profitable, and they're going to have more in the way of capital and reserves to ride out this storm better than the weaker half, for sure.
And here's another question that we had, and it was actually one that I was going to answer, but now I'm thinking this is actually one that you should answer. We've seen if you have a bond portfolio today, the yield on the portfolio is below the cost to run the institution. So so if you look at the yield on your securities portfolio and you comp that to the non-interest expense to average asset ratio, say, do that. I mean, I think analysts on the phone might actually want to run that ratio themselves. You know, it actually now I'm earning on my securities portfolio less than the cost for the expense cost to average assets. So the question should be, I think, you know, how much consolidation are you thinking will happen? I would assume that the natural implication is either you can bring that cost structure down substantively, or you're going to consolidate. Well, let me ask you the first. Do you think that there's more? I mean, you've been in front of financial institutions since, I don't know, dinosaurs, Van? I don't remember.
Correct.
I tell people you're older than me, even though everybody knows that's not true. But you must have some thoughts here about, you know, do you think the industry, like we saw after the financial crisis, a substantial cutting and efficiency drive? Will we see another big drive like that now? Is that what you're looking for?
Yeah, let's take parts of that one by one here. One, in terms of the investment portfolio, right, serves two functions. Its primary function really should be a liquidity portfolio, right? Liquidity, you know, very, very important in terms of getting through this period of uncertainty as its customers draw down on credit lines, right? The banks are supposed to be a source of strength for their customers in a economic downturn. A big part of this is maintaining a liquidity portfolio, and there's a cost associated with that, of course. And I think as you highlighted here, with what's happening to yields, the cost of being able to provide that liquidity is becoming more and more real. The second part of that is some of this has to be an earning asset, but I think, again, that is a secondary consideration to what the primary function of the investment portfolio is. At the end of the day, banks are going to make an acceptable return because of something they do outside of the investment portfolio. For the vast majority of banks, it's lending. For the very largest banks, it can be a whole variety of other services and capital markets businesses that are going to drive an acceptable return. So again, let's be clear about really bank revenue streams and which ones are most important. Ultimately, you know, banking is a competitive business. It's got an awful lot of capacity. It is, you know, in the U.S., we have far less consolidation than any other developed country in terms of its banking system. We've watched for 30 years now a pretty steady drive of consolidation to improve the efficiency of the industry. And compared to where we were 30 years ago, we've made enormous strides. As the industry continues to evolve, are those pressures going to go away or change? No, it's not like, you know, banks have gotten efficiency ratios to 60% or 55%, and that's good. We can now declare victory over it. Competition, and by the way, with banking profitability at least going into this crisis at or near record highs, that suggests that, you know, competition can continue to drive down or make more competitive pricing on both assets and liabilities, which is going to make managing the efficiency of your non-operating costs paramount. So that pressure is still going to be there. It will continue to be part of the drivers that will drive more consolidation in the industry. And I don't think any of that changes just because we're in a pandemic.
Okay, thank you, Van. And just before one more question. Nathan, you have not had a question yet, so I've got a question also for you. So we get bank earnings coming in the next couple of weeks. If I am signed on to KBRA Analytics, how soon will bank earnings get posted on, for first quarter, get posted onto the analytics software?
Oh, yeah, that's a great question. I know everybody's going to be paying a lot of attention to those numbers. So with the fundamental gap data, we're committed to turning that around in less than 24 hours. For the larger institutions, we want to do that in just a matter of hours. And the same thing goes for the call reports and the Y9Cs for the bank holding companies and also even the credit unions as well. So as soon as those filings are made available through the FDIC, Federal Reserve, or the NCUA, we turn that stuff around immediately.
Okay, that's great, Nathan. So just before I turn back to Van to say goodbye to everybody, I do want to mention that, we had a lot of questions. We didn't get a chance to answer all of them, as you know, because we try to keep this to an hour. But we will be, we have your emails, we have the questions, and we will get back to you. If we have not answered this call, we apologize on the call, but we will get back to you directly. I also want to mention that all of our research and reports are free on KBRA.com. And finally, I want to say that the slide deck and two of the reports that are connected to this, including the one I wrote just the other day on current expected credit loss, are available under the handout section for this webinar. So thank you very much. We've had an unprecedented number of people on this call, and I thank you for sticking with us. Let me just turn it over to Van to say goodbye.
Thank you, Ethan, and I'll pile on here on the research side by mentioning, for example, yesterday our commercial real estate group published a very thorough piece, property type by property type, on the risks of those properties to coronavirus. So it informs the work that we do, across our platform. There's a lot of it available for free at KBRA.com. So make yourself familiar with the website. You'll find lots of valuable things there. Again, thank you all for dialing in, and look forward to working with you in the future. Thank you.